All right, today is Monday, April 8th, 2 p.m. section. I'm recording this. Uh, Basically, what we're going to do today is we're going to go over the Costco assignment. And as part of that, we're going to make some final modifications to our valuation model. All right, you're going to have to put them into your model. And so going forward, for both your homework assignment next week as well as your team project, you will have to use the final modifications as part of your write-up and as part of your presentations. Okay? And I'll talk about what they are in just a minute, so you might want to at least have your as-is model handy. Right? But before we do, let's just talk about the Costco as-is that you did. So the first thing you would have done is you'd have gone to, it's a little smaller, you'd have gone to Costco, you'd have gone to FA, and you'd have exported your custom model, whatever you called it. Mine's called the model template. Six years of historical data, no extra columns. Okay? So again, hopefully you change your settings to 6 and you uncheck those 4 boxes so you don't have any miscellaneous columns. Otherwise, it's going to cause a problem when you import the data. And then you would basically export to Excel that template. Okay? When you did, you would have gotten a file that looked like this, the Costco data file. Right? Now remember, when you first export this, this is not going to have numbers. It's going to have the links to the database. So you have to copy paste special values, turn them into numbers, and then get rid of the long dashes, replace it with zeros. Control find, usually find, copy the long dash, paste it, find it, replace. I think there's like 38 of them or 48 of them that you have to replace here in this file. Okay? You have to do that every time. Now, again, if you have trouble exporting, it could be for one of 2 reasons. Right? So if you're in Bloomberg and you hit File Export, doesn't go to Excel or errors out, then you might not have the Excel with Bloomberg added loaded. Make sure you load that first before you export data. Okay? Or problem number 2. If you remember on the first day of class, I said it's not a good idea to tell your friends about this lab. Right? Kind of Fight Club mentality. Right? So no one talks about Fight Club. I'm going to give you reason number 2. Okay? Happened to a student in the last section. She had asked for an extension because she couldn't be here on Monday. I gave it to her, and she was actually trying to get the data today, right as the class started. She was sitting right there where you're sitting. Okay? Wouldn't export the data. She moved to the computer to your left. Wouldn't export the data. She experienced problem number 2. Every one of these terminals in this lab and downstairs, as per terminal, has a monthly data export limit. When you hit the monthly export data limit, won't export any more data. And those 2 terminals have now hit the monthly data export limit, and it's only, what, May 8th, right? So that's a problem. And so basically, we can't do anything about it. It's by terminal, right? So here's the deal. The data export limit that Bloomberg puts is not based on megabytes or gigabytes of data exported. It's based on dollar value of data export. Okay? So when the terminal hits its dollar value limit, it won't export any more data. And they consider some data very, very valuable. Okay? Unfortunately, that's what the PhDs come in. Okay? So they swarm this lab like locusts, gobbling up like a vampire, sucking out all the data, and as soon as it's dead, they move to the next terminal and suck out all its data. Okay? And that's a process we can't stop. Right? And so basically, that's what might be already happening to some of these machines. Right? Because as I said, it's not how much data they suck, it's the type of data that they're taking out. And for their research projects, they usually do some very expensive data as far as Bloomberg's concerned. And it wipes out our lab. And it doesn't reset until the first of the next month. So those terminals can no longer export for the next 24 days. Okay? So what does that mean for you? Sorry, is that if you run into that problem, you just have to find a terminal that will let you export. Right? Hopefully you didn't have that problem with Costco, but you might start having it for the next couple projects. So my other recommendation is by Wednesday, when I tell you your next week's project, get the data sooner rather than later. right? Just so it is likely to less interfere with you. And it doesn't just apply to this lab, it applies to the lab downstairs as well. So just FYI, okay? So there's two reasons. If you have data export problems, that could be the second reason, right? Now, the other thing that we would do is we then take this file, select it, copy, go to our as is, from either Nike or NVIDIA in this case. Select this whole first tab, right click, paste special values. Again, don't copy paste. When you copy and paste across Excel worksheets, Excel models, it could actually make a link to that previous file, which means every time you open the file, it'll say, where's the file that this came from? And that's annoying. So my sense is copy paste special values. Just copy the numbers. Okay? Overwriting cell for cell. Once you do that, go to the CFI. Check your CFI, make sure it balances. Right? I knew it was going to balance for Costco. I knew it was going to balance for Nike. All right. I don't know if it's going to balance for all of the companies that you just checked for your group projects. Right? So here's the point. If the CFI doesn't balance, then you need to find out why. So go to the TFI or TII. If the TFI doesn't balance, what financial statement is the problem? By the way, this is a final exam question. If the TFI doesn't balance, what statement? Yeah, that's the balance sheet. So you know you got a problem with the balance sheet. If the TII doesn't balance, it's the income statement. Okay, so basically, if the CFI doesn't balance, look at the previous two. They'll hint what's missing. Okay, and so what we've been doing over the years, and you can see this at the bottom of the model data tab, is every now and then we run into a company that the accountants have an account on their income statement or balance sheet that we haven't seen before. Okay, now I think we have a pretty good universe of companies where this doesn't happen randomly, but it happened last semester. And last semester, there was a company that one of the teams did where the company had deferred compensation in long-term liabilities. Okay, that was a new account. We hadn't run across that before, and their statements didn't balance. And so the only way to fix that, once we identified what the missing account was, is we had to put it at the bottom of our model data list. That's why it's kind of randomly down there. And then we had to hook it up to the balance sheet. Okay? And so then it's a question of just go on the balance sheet and say, do we hook it in by putting it as an other current liability or an other, other long-term liability or a non-operating long-term liability? So then you got to make a determination. Is it operating or non-operating? Okay? And if you hook it up, then it should actually make everything balance. Again, probably won't happen to you, but if it does, you have to fix it. Because in this class, if you turn a non-balancing CFI in, it will not be graded. If you have a non-balancing CFI on your group project, your team will get a 0. I don't care what you say in 10 minutes. I'm not going to listen to you. You won't present, right? Invalid models do not get graded in this class. So therefore, you can't turn a non-balancing CFI, historically or forwardly, right? So back to very important step in the process. Again, hopefully it doesn't happen to you, but that's also why I would strongly suggest taking the companies that you just picked, put the data in, make sure you don't have this problem, okay? Because before you go fix the problem, maybe you can switch to a different company. It might be easier, right? I don't think it's going to be a problem for most of the companies that you picked, but as I said, a couple of them, we haven't done them before, so we'll see, right? So back to this. We put in our data, make sure the CFI balances, then check your last reported year, which is 2023, and start going to the assumptions update. Last reported year, 2023. Operating cash. Now we've left operating cash at 2%. If you feel that one of the companies that you've selected should have more operating cash, you can always make that number higher, right? I wouldn't make it lower, but you can make it higher. 2% is 1 week of cash, right? So you think they need to have a month of cash, that's 8%, right? So again, you could adjust that if you think it's necessary. WAC, you should use the current WAC. This was the WAC of Costco, essentially end of day Friday, right? So hopefully that's about your WAC, 9.6, because I was using Nike previously. Nike was 9.7, so I had to update that, take a screenshot. Next, we go down to the shares outstanding and the current share price off your DES screenshot. So take the screenshot, 443.5 shares out, 712.94 was the price of Costco when I did my screenshot. Okay. Third screenshot, the EEO, put in the consensus revenue EBITDA for the 5 years. Okay. And forward year 2 and 3, EV to revenue, EV to EBIT. Okay. By the way, when you do the EEO, you don't even need to know the years. Down here at the bottom for multiples, forward year 1, 2, 3. These two columns will be always what you need in Bloomberg for our model. Okay. All right. Once you've done that, come over here to ratios. Next, probably look at the tax rate. 26% was under GUID. We looked up the company guidance. They gave it guidance for the tax rate, much higher than what Nike was if I didn't change it. By the way, when I used the model, this EBITDA was Nike's EBITDA. It was around 17%. Okay. Obviously, that's going to cause some challenges because Costco doesn't have an EBITDA margin nearly that high. So I needed to put in something more reasonable for Costco. Yes, sir.
Is it fine if we found different, similar but different tax rate?
Where'd you find it?
On Bloomberg in one of the, like the JP Morgan tabs.
As long as you referenced, I got it from the JP Morgan report. So absolutely. All right. So I'm going to take a second here to answer not only his question, but answer it more broadly. All right. I do not expect you to purely plug and chug everything that goes in here. All right. Matter of fact, I'll tell you, a couple semesters ago, one of the companies had a negative whack. All right. Clearly that's impossible. And I'm just saying, Bloomberg can make mistakes. And sometimes you're going to run into data that doesn't make any sense. And you might have to put in something more reasonable. Okay. And that's the point. Maybe you believe that the JP Morgan tax rate was more reasonable than the 23 guidance, and you put that in. It's perfectly acceptable because you got to use kind of common sense here when we do this. Now we're kind of following a process, but as I said, sometimes in that process you're going to see some crazy stuff. In fact, in the 11 a.m. section, somebody came to me after they started plugging a couple of the numbers in, and they said our company has a 0% tax rate, and I said, well, I don't think that's what's going to be in the future. Do you? He's like, no. I was like, well, then don't put 0. Like you got to put in something else. Right, and so that's the point. Like there is some thought that goes into what we're doing here. It's not just a purely plug and chug exercise. Okay, but back to Costco, somewhere around 26%. Got to solve for an EBITDA margin. Remember, here in the trading multiples, we get an operating margin 3.7 to 3.8. Okay, so basically, I made my as is EBITDA 4.7 to get to an operating margin of 3.8, EBIT margin of 3.8. And then for the 1 year growth rate, 29, eventually people do regress towards the mean. So I made that 5% versus 7%, which is equal to previous year. I don't think it's going to make too much of a difference, but I am regressing to the mean a little bit and we get to the out years. Okay. And then productivity, Costco's productivity, 9%, invested capital to sales, I think is going to stay around 9 cents. I don't think I need to really change the productivity, so I'm going to leave that alone. I think it's reasonable for Costco. And finally, I'm going to goal seek my G and get somewhere around 8%. Okay? And again, your number will be slightly different, 799, 798, 801, depending on when you did your share price, but it should be somewhere close to 8% in your as is. Right? Did everybody get these numbers approximately? Look similar? Any issues with this? With the as is? Okay. So, first part is we're going to start to do our bull and our bear next. So we're going to save our as is. But before we do our bull and our bear, we need to do, as I said, a proxy EIC, which means at a minimum, if the company has a BICO, start with a BICO. Look for some of the issues with Costco. Right? Now, one of the issues they talk about in the BICO is supply chain. That coming out of COVID, there were some challenges with supply chain, which affected Costco. It's one of the reasons why we had high inflation. Supply chains kind of resumed to more normalcy. I mean, every now and then there's a disruption. Think about the Port of Baltimore, although that's probably short term. Right? Although on another side note, I saw the governor on some news program yesterday, and I think they're going to actually open up the passageway next week. Like they're making crazy fast progress on clearing that bridge, which is really good. Because if you know the data, like the Port of Baltimore is like the 5th largest port on the East Coast. And if they don't get it open, it's big disruptions. So they're working really hard to open that port. And it might actually open up faster than people thought. But that being said, it's probably not a long-term issue. But supply chain issues, does that play in the bull and the bear? But the other reason is Costco I gave you as a company because they're so predictable, right? And part of the reason why Costco is so predictable, and I personally love Costco, go there every Sunday, is basically their philosophy, right? Why is their EBIT margin, their operating income margin, so similar year over year over year historically? Everybody know? Yeah.
I think they have pretty steady prices, like their membership hasn't been like.
So they have membership fees, which is pure margin for them. They don't change that too often, every 3 or 4 years. Yeah.
They obviously have like a really wide range of products also that doesn't like skew it.
It's not the diversification. There's something else that's going on. Yeah.
Their margin is purely based off of their private label and the memberships. Everything else.
They're helped by the private label and the memberships, but it has to go more their philosophy of margin. Yeah.
They don't look to make money on anything else they sell.
They do like to make money, but it's not a lot of money. But yeah.
It's all about just passing savings on. Like they haven't raised their fees in over 6 years. Like it's just about treating people as cheap as possible for very, very slim.
So I'm going to say it a different way. Costco believes in sort of a constant markup, right? So they target a gross margin. And what that means is regardless of what the product is, it's going to get that markup, that margin, right? Whereas other retailers will say, oh, this is in demand, I'm going to charge people more for it, right? And I think that's one of the reasons why they've developed a lot of trust with their customers, because no matter what it is, you're not getting a bad margin. Like it's a reasonable priced margin, okay? And that's why they will always offer low prices. And they have said they are sacrificing profitability. The analysts complain. They're like, you could be raising your prices. And they're like, yes, we could. But that's not our philosophy. Our philosophy is volume. Like we want to serve the customers. That's why when I go on Sunday, the place is overwhelmed, it's swamped, and every time they open up a new location, it's quickly swamped because basically people have developed a trust. Matter of fact, talking about the food, the $1.50 hot dog, right? They got a foot, if you ever go there, $1.50 foot long hot dog and a drink. They haven't changed that in like 20 years. And the analysts are like, are you ever going to raise the price of the hot dog? And they're like, no. Like, we don't care if we lose money on it. We're just going to have the $1.50 hot dog and a drink combo. Matter of fact, the other one is what? What's the other good food deal that people love about Costco? It's not I love the pizza, but that's not the deal. It's a chicken. $4.99 for the rotisserie chicken. They have not changed that price in like 10 years. And they said they will not change that price regardless of the cost of chicken. Matter of fact, another feature that makes their rotisserie chicken so popular is if it's been on the shelf for more than 2 hours, they throw it away. Seriously. So they believe that they will not sell a rotisserie chicken to you that's been sitting out there for a long period of time. Right? It's a different philosophy than Safeway. Right? So that's the point. Like people trust these things about Costco, and that has given them the ability to grow at this constant price, and they're willing to leave margin on the table, but that actually makes them very predictable. Right? Their margins are extraordinarily predictable because they're constant. Right? And they're not going to be like a Macy's who's going to mark it up and have sales. Or like Costco's not really a coupon company. It's not what they do. Yes? So hand question. All right, I say that because this is going to play into our bull and our bear, because you notice the EBITDA margins are expected to increase to almost 4.7. Why? 4.7, 4.8. What's changing? It's not their philosophy. What's changing to cause their EBITDA margins in the future that the analysts are expecting to go up? Yeah.
Is it cost program?
Is it what?
Cost program?
No, it's not the cost program. This should have been in your bull and your bear. And I don't think it was really highlighted in the BICO, to be honest with you. But something they've been talking a lot about. Yeah.
Rising membership fees?
They're raising fees, but that's not what's causing it to consistently go up higher. Yeah.
Opening new stores,
What types of stores?
international.
Part of it, but what types of stores? The big push. They're starting it this year. It's new for them. Yeah.
Online grocery?
Nope. Disappointed you guys didn't see this about Costco. As I said, it wasn't in the BICO, but it's been, if you look at CN Company News, they're talking about it. And the analyst report's starting to talk about it. Costco's opening up a new type of store to expand. Specifically, furniture and appliances. So they're going to have dedicated furniture and appliance warehouses. They're going to be much smaller than the traditional warehouse. That's all they're going to sell. right? Because right now, if you go buy furniture and appliance, like a washer, dryer, Costco, they don't keep them in stock in the store. It's basically mail order delivered to your house. The new stores are actually going to have furniture and appliance inventory specializing in that. And the reason why is they actually think that furniture and appliances are a higher margin business. And they'll make more money selling furniture and appliances if they focus on that. And they actually think that you don't get the greatest deals at like Best Buy and Lowe's and Home Depot. And so given their margin philosophy, they will undercut them in price and they'll make more margin than the traditional warehouse. And they think that that's another vector of growth. And they're pushing a bunch of these stores. They're gonna start opening them around the country this year. Yes?
Will this be included in the membership fee or is it separate?
My understanding from what I've read about it is it will be included in your membership fee, but it'll be a different, I don't even know if they're going to call it Costco default, like it might have a Costco different name, but you'll go into that store with your member ID and then you'll basically buy your washer and dryer and have it delivered and have the local inventory to do it. Okay. And again, lower cost, but they see that as a way of expanding their business. So yes, they're going to open more stores. They're going to open stores internationally, which will be part of the Bull and the Bear. That's all in there. But this other type of store will also swing it. And you're already seeing the analysts with this slightly higher margins are giving them credit in the EEO for this. Okay, it's just FYI. But that's actually going to play into the Bull and the Bear, okay? Because part of the bull scenario is how successful the furniture and appliance business is going to be, right? And if it's really successful, it could be better numbers. If it's poorly received, it could be worse numbers, right? Matter of fact, same thing, international expansion. If they successfully expand international, better. Is it worse? Not. So these are some things we'll start talking about in our Bull and our Bear. But again, that's what I said, you got to do some minimal EIC. Now, next week, when you're doing your group project, and there's 8 of you on a team, I expect in the next week more than just, oh, I spent 5 minutes looking at a BICO. Okay? So I'll be very disappointed if you don't know anything about the companies that you're talking about when you're talking about your Bull and your Bear scenarios and the issues that they face, as well as the industry. So back to this. I'm ready to do my Bull and my Bear. Okay? But before we do our Bull and our Bear, here is where we're going to make a modification to our models. So going forward with all future assignments, you're going to have this modification. Okay? So, detour. First, under FA, on the very first FA screen in Bloomberg is how Bloomberg calculates enterprise value. Okay? So that is the Bloomberg definition of enterprise value, which is actually the one taught in most finance textbooks. Okay? And they actually show you the formula. The formula for enterprise value, as Bloomberg estimates it, is debt, interest-bearing debt, plus equity, minus cash. That's the definition that Bloomberg uses. Debt plus equity minus cash. Is that the Modigliani-Miller true definition of enterprise value? Debt plus equity minus cash? No. The actual definition is debt plus equity is enterprise value. We don't subtract the cash. Bloomberg does. Why? This goes back to what I was kind of talking about last week, right? And the fact that I'm getting old. So I was at Wharton in the 80s, okay? And we had gotten lucky because most of the professors there were PhDs that were at Chicago in the 70s that won all the Nobel Prizes, which were hired by the top schools, including Wharton. So my professors for finance had literally just come from Chicago, and they were literally not only inventing corporate finance, they were writing the original textbooks. So you're using Brearley and Myers, I don't even know what edition are. We use the first edition, all right? We had the first edition of Ross and Westerfield. Like, we were the cutting edge stuff we were learning at the time. And it was an amazing time to be in finance, boring as the subject is. But the point of the story is that this is when Bloomberg started and when Bloomberg created all these ratios. And as I told you last week, Bloomberg doesn't change ratios because they are so embedded into the DNA of the financial community that it would be an earthquake, like they had in Manhattan last week, by the way, New Jersey. But it would be an earthquake for them to change a formula. So they just don't. So here's the point. This formula for enterprise value has been around since the 80s. So here's the point. In the 80s, when you think about non-operating assets, right, they didn't really exist. It was cash, right? Like, we didn't have a company like Microsoft that put billions of dollars into OpenAI and owns 30% of their business. Like, that just didn't happen back in the 80s. We didn't have all these cross-company investments and the IP that was so valuable. Companies were kind of boring and they're traditional plain value. There are a couple exceptions, but they were truly exceptions. So the point is, cash, particularly what we would call excess cash, was actually the biggest non-operating asset at the time. So what they did is they took the enterprise value, subtract all the cash, and if you take the enterprise value, subtract all of the non-operating assets, you know what you're theoretically left with? The operating value of the firm. So what Bloomberg calls enterprise value, what you learned as enterprise value in the textbooks in 301 and the other classes you took in finance, is actually closer to what Modigliani Miller would call operating value, right? Now, in the last 40 years, things have changed even more because there are a lot of cross-company investments and a lot of types of non-operating assets and liabilities that never existed before. And that's where McKinsey comes in. Because McKinsey's like, look, these formulas don't really reflect what's happening in the world. That's why they have adjusted in the book TFI, TII a little bit differently to account for more of these things, right? Which is what you're learning in this class. So it doesn't make it right or wrong. It's just this was a simplification that's been around for a long period of time. So what I want to tell you is sitting here in our model in the valuation tab is we calculate a more traditional enterprise value. And in this cell, 1 over, in E18 and E19, we're going to add a BEV, which is the Bloomberg enterprise value calculation, to our model. How does Bloomberg calculate it? Because we're going to be looking at data in Bloomberg. We're going to compare it. We need an apple and an apple. Okay? So in cell E19, we're going to call it BEV, Bloomberg enterprise value. Okay? And in cell E20, we're going to put in a formula. Okay? And we're going to use the exact same formula Bloomberg uses. So what Bloomberg uses is debt plus equity, which is, by the way, what we call enterprise value. So our formula is D19 minus all of the cash. Again, in Bloomberg, they don't separate operating and excess cash, right? They use the concept of net debt, debt minus all cash. So we're going to do that. We're going to take enterprise value minus all of the cash. So D19 minus on the balance sheet, G4 and G5. Because G4 and G5 on our balance sheet is the last reported year operating in excess cash. So we're going to take enterprise value minus last reported year operating in excess cash, and that's going to be closer to what Bloomberg will call enterprise value. We're going to have that in our model. Everybody with me? Everybody do that? Or at least know you're about to do that before your next assignment? Okay. So now we have a Bloomberg enterprise value. Then what we're going to do is we are going to create a new worksheet at the end. And we're going to call this worksheet tab multiples. Okay? It doesn't exist. Add it at the end, after the valuation tab. Okay? And then we're going to go to Bloomberg. And for the company we're looking at, in this case Costco, we're going to go to RV. And we're going to either use the analyst curated or the BIX. Notice that for Costco, their BIX is going to change on 419. So in this case, I'll use the analyst curated. But these are the analyst curated peers for the company I'm looking at, in this case Costco. So these are representative discount retailers. And we're going to go to the tab that says comp sheets. And the first comp sheet is called equity valuation. And we're going to export that worksheet to Excel. Now, for whatever reason, when we do this, export worksheet. What am I going to call this? I'll just call this comps. Yep. No, I don't want to put it there. Why is it not doing export to, oh, because I was doing export worksheet. Export to Excel. I can't actually click on the right button. Sorry, don't export to a worksheet. Export to Excel. All right, for whatever reason, when you export from the RV screen there, it actually gives you real numbers. So you don't have to convert these. Okay, so those are actually real numbers. Okay, they're not formula lookups. But that represents, for all of Costco and all of the peers, all of the current multiples and forward multiples for EV to EBITDA and PE based on the current share price. Okay? Now here's what we're then going to do. We're going to take this entire tab. We're going to copy it. We're going to go to that new worksheet that we just created. And very important, in row 2, don't put in row 1, paste special values. Because again, when we paste across the worksheets, I don't want to have a link to the other worksheets. So I just want to put the numbers in there. Okay? So the first row is the market cap weighted average. And then we have each of the companies. Right? But here's the point. Right now, for forward year 2, the EV to EBITDA multiple of Costco is 25.29, and the industry average, based on all the companies on this list, is 16. Okay, Costco being, if you look at all these numbers, the highest EV to EBITDA multiple on this list. Okay? And here's why that's important. Because EV to EBITDA is what we see in the real world. Our model, our share price that we're forecasting the model, estimates an EV to EBITDA. Okay? So here's what we're going to do in cell D1. Equals, from the valuation, the Bloomberg equivalent enterprise value, the Bloomberg enterprise value, divided by, from the income tab, the historical EBITDA, which is G8. That is our model's historical EV to EBITDA, comparable to Bloomberg, which is trading at 29. Okay? Now, EV to EBITDA next year equals DCF, BEV, which is E19, divided by assumptions, B13. That's next year's EBITDA forecast for the consensus, 27.34, and equals, for the second forward year EBITDA, E19 divided by assumptions C13. And that's the second forward year EV to EBITDA. Okay? Now the numbers should be relatively close. They may not be exact because, well, number one, the values are a little delayed on this screen that we just exported versus the real-time data that we're pulling from the EEO. Okay, so just the time delay might be a little different depending on the price of the company, but they should be approximate. Okay, and then we're going to do the same thing with the PEs, right? So the PE based on historical data in G1 equals, from the DCF valuation, D26, the price, divided by income, historical G22 is net income. That's a PE of 50. Forward year 1 equals price divided by income H22. And for the third forward year equals equity value divided by income I22. So that's the trailing PE, forward year 1, forward year 2. Trailing EBITDA, forward year 1, forward year 2. That's what's created in our as-is model. Okay, this is the average for the industry, and this is Costco today. Particularly the forward years are fairly close. Now the PEs might be a little farther off than the EB to EBITDAs, and if you remember when we built our income statements, a lot of things I was like, don't worry about everything below EBIT. We're just going to kind of use last year. In the real world, the analysts don't do that. They actually forecast the more detail of the entire income statement. So their PEs might be a little bit different, but it shouldn't be like a factor of 2 off. It should be fairly close, especially for the forward years. And you can see, like our forward year PE is 44.92. The analysts are at 44.38. So we're pretty close in the forward year one, and forward year two, 40.8 versus 40.86 for the PE. So we're pretty close. They don't have a lot of other weird stuff happening with their income statements. Again, nice value of Costco, right? And then you need to save this, okay? And here's why. I'm going to now do File, Save As, my bulk. So I'm going to go here to my ratios. And what I'm going to argue is that they have success in the furniture business. It's not necessarily their expansion, because the expansion, they typically have similar margins when they open up new stores. So it's more revenue growth than margin growth. But they really do have more success. So I'm going to say is, instead of 4.7, maybe this gets as high as 4.9. Again, their philosophy is still low cost. So it's not like they're going to double their prices for furniture compared to what they sell in a store, but maybe they get a little bit higher margin mix of merchandise for furniture and appliances. Okay? And then the real question is, if they do grow at a faster rate, they're already growing at 8% a year, how much is faster? Like 8.5, 9? Like, what's reasonable? So I'm going to put in 9. Okay. By the way, when I do that, that's a share price of $1,841.57. Today they're at $700. Okay, is that reasonable? Okay, so this is the other side of the sanity check. That $1,841 share price is a EV to EBITDA multiple 80, 71, and 65. Right now they're at 28, 27, and 25, and the industry average is 17 to 18. And there's no other company higher than them. So you have to ask yourself, do you think that a prominent fund like a BlackRock is going to suddenly pay an EV to EBITDA multiple of 65 to buy their stock? Like, no. Like, you'd be smoking a lot of that legal cannabis to believe that one, right? So basically, that's not realistic. And that's the point. Like, this is called a sanity check, right? Because when we're doing these values, you're like, well, what is a reasonable? Gee, we're just kind of like picking one out of the air and say, this sounds right. Well, I want to use some triangulation with the market multiples to help us do more reasonable sanity checks. And I'm just telling you, in the next 12 months, Costco's not going to more than double their share price with this level of earnings. And that is just not realistic for that company. They're just not going to have an NVIDIA-like moment. Okay? It's not realistic. So, infinitesimally possible, maybe, but it's not very realistic. So that's not something I want to put in. So what I might end up doing is I might put in something closer to this that says, okay, maybe this goes not to 4.9, but it goes back up closer to 4.8 or 4.7. But what's really going to affect it is my G, and instead of 9, maybe I make it 8.2. Well, if I get to 8.2 G, now I'm talking about a PE that's in the 30s. Or sorry, EV to EBITDA multiple in the 30s, and a PE that's in the 50s. Okay. Now they're already at the high end of the industry, so it's a question of how much more will people pay, right? But what I'm telling you is, I'm more likely to argue that this is achievable at the high end than the scenario of an 8% G. Okay. But I'm already well above the industry average, which is going to tell me another thing, that when you're buying Costco as a more mature company, like, you're already paying a premium, right? Would suggest, in a way, kind of like we were talking about with NVIDIA, that it's going to be hard to go too much more upside on this company unless they really change their philosophy and start charging different margins. Okay, so that could be the bull. Like, they got a new CEO coming in, and the new CEO says, it convinces the board to say, no, we are going to abandon the founder's mentality, and we're going to completely change our margin philosophy and break the contract with our customers and make more money. Okay, but that's not what they're saying. And so if they don't, I'm just telling you, you start to look at these numbers, it's harder to see a dramatic upside. Now, by the way, doing this gets them to a share price of 823, which is still in the buy range. Okay, but I think this is a more reasonable top end than 1700. By the way, we'll do the same with the bear. Okay, so once we have this, save, close this, get to my modified as is, file, save as the bear. Same concept, right? And let's just say I come up with a scenario that says, okay, the furniture rollout's a disaster. They start closing the stores after a couple of years. They don't really have the long-term expansion, and they don't really get some of the loyalty that they've had historically, and there's just more competition from other stores. So that ends up, and supply chains become issues more long-term. So their EBITDA margin falls closer to where it is today, 4.2. Then the question is, what's the growth going to be? Well, maybe the growth's going to be 5% long-term. Convince myself much lower growth. Still above the economy, 2 to 3, but closer to 5. Well, what's this share price? 276. What is this multiple? Well, now their multiples, now they're in range of the industry, okay? But now they're below Walmart, and direct competitor, they're below BJ's, right? And again, for those of you that shop at BJ's, maybe you love them, but they're the worst of the stores, okay? Costco's the leader, Sam's Club is second, BJ's is the bottom of the barrel, okay? They don't have any competitive advantage. They don't have the size and scale. You don't get the lowest prices at BJ's. BJ's is successful because there's not a Costco or Sam's Club nearby, and you got nowhere else to go, so that's where they basically make money. They're kind of like the Dollar General of the industry, okay? And so they're just not the best of the discount clubs. They're not the most well-run. They don't have the loyalty. They don't actually have the lowest cost, but they're warehouses, right? And so people will go there, right? I don't, right? But that's the point. What you'd have to say for this scenario to play out is that Costco's losing all their competitive advantage, and they're going to actually trade worse than BJ's the next 12 months. Then everything I just said, Costco's going to lose. All right? Do you think that's likely? No. So even though that G at 5% is something I could plug in and talk myself to not growing nearly as fast, that's probably a grizzly bear of a scenario. That's probably too bearish for where they're likely to be. So I'm probably not going to go to till 5%, right? I'm more likely to probably put it at assumptions 7, which is still lower than 8, and that's a share price that's now in the 400s, so still lower. But now my multiples are still slightly above Walmart and Target and BJ's, for that matter. Not as bad, and they're kind of like becoming more average. Yes?
Would it be possible to argue that 5% and then say that like the industry as a whole is gonna like not grow as much, so that in reality it's still better than BJ's?
Yes.
Okay.
That is possible. I personally, I wouldn't argue that, but you could, and I can't fault you for that if you could source it with data and facts. But that's the way you'd have to play it out, right? But that's the whole idea here. It's called the sanity check, all right? And it just helps us by looking at the multiples to say, are the assumptions that we're putting in reasonable? So that gets back to your next assignment in the paper, in your PowerPoints. In addition to, here's my bull, here's why to change the bull, the additional part, why it's reasonable. Here's my bear, here's why I changed it, why it's reasonable. And use the ratios of the other publicly traded peers to help you with the reasonableness, right? And I'm not saying it's a flat range. Like Costco's already at the top of the range here, and they're going beyond the top of the range, but that's the point. Like you're paying a big premium for Costco today. To do better than that, you got to pay an even bigger premium. I'm not saying it can't happen, but how much bigger premium are people going to pay for this company? Like that's what you have to start thinking to yourself when you're starting to put in some of these assumptions. So it's just a way to help you kind of temper so you don't really get too far away. Because the other problem with our model is it's kind of a cumulative effect. Meaning we change the margin a little, we change the tax rate a little. It all seems reasonable. We change the growth a little. Independently, all three of those things seem reasonable, but the collective impact of all three starts to become much, much bigger. So again, it can't happen, but it helps us kind of put ourselves to a more reasonable models. It's called the sanity check. Questions, comments, concerns? All right, so you do your bull, you do your bear, and then your targets where you think you're in the middle. Personally, I actually think Costco is probably closer to a buy only because it's a hold buy, meaning I actually think these numbers that are in here suggest that there's more downside than upside, but I actually think that they're going to continue hitting some, kind of like NVIDIA in the short term at least. I'm consider hitting their upside, but it's not that much upside. Like they're going to plug along, maybe they'll get 20% upside if all things go right, 15, 20, but they're not going to double. Right? So they're not going to see what happened to NVIDIA in the last 12 months happen to Costco. But that would still be, for that size company, that'd be a great rate of return. So I'd probably put them at the end of the, low end of the buy, high end of the hold category. It's where I'd probably end up with my target. Okay, slightly, because the growth of 8% is just high. All right, so to go even to 8.2, that's, I'm worried 8 is hard to sustain for a company of that size. Right, so I'm just saying, like, to do better than that, it would require something. But that's the other question, which is what they could do. Not that they will, but they could change their margins, and that changes the whole calculation of the G, right, down the road. But regardless, I'm betting that they maintain their competitive advantage, that they are somewhat successful with the new store launches, and they stay busy, and so they get the growth. All right, questions, comments, concerns, crippling fears about any of this? Did you make the changes to your models? If you didn't, you need to, okay? Between now and the next class, Wednesday, we'll practice a little bit more, make sure we did this, and then I'll give you on Wednesday your assignment for Monday. Okay. But as the eclipse is about to start to happening, we're going to end class a couple minutes early. Make sure you wear some glasses. See you guys on Wednesday, and don't forget to sign the sign-in sheet before you leave.